This is a BC Eagle accounting video. What you see before you is the printout of the description and template of the business analyst exercise from chapter 19. In this exercise, you have an individual, Maria Young, who is the sole owner of the Purl of Great Price company that makes high-end sweaters. They're knitted and they're pretty much upscale. The company has 3 employees and it has some machinery to help out with the stitching business. If you have not done so already, a great tip is to print out the problem and the template so that you are able to see all the information in one place. The difficulty with this particular exercise isn't that it looks so different than anything that's in the book. It's just that you can't see the entire thing when you are using Cengage. So I suggest stop the video, print the template, and then return to the video and listen to the message. What you have is a series of 9 different steps that deal with the allocation of manufacturing costs to work in process to 2 jobs. The company has 2 jobs. One is job number 62, which was started at the beginning of the period, and then the second job is job number 83, which was begun on December 10th. What you should be able to visualize is that each of the jobs, like job 62, will have its own work in process T account. For job 62, it will have a beginning work in process of $5,404 that was started sometime in November. All this activity that you see here is for the month of December, as the problem states. And then we need to add direct materials, direct labor, and factory overhead. Direct materials will come from the materials requisition information, and direct labor will come from the time tickets. Factory overhead is estimated using a predetermined rate, a PDR, that's developed at the beginning of the period. The materials requisition is shown to you right here, and it says that for job number 83 there were 600 skeins of yarn that was allocated to the job at $5 a skein for a total of $3,000. So this $3,000 that you see in the materials requisition dated December 10th is to be applied to job number 83. So that means that there is no material applied to job 62 for 2 reasons. Number 1, it was in process in November, and number 2, there is no separate material requisition for job 62. So the additional amounts from the materials requisition, $3,000, would be allocated to job 83 for direct materials. Information from job 62 to complete this. Where did the beginning work in progress come from? Well, each job will have its own work in process T account, or it will have its own job cost sheet. The connection is that the work in progress is evidenced by the job cost sheets. The job cost sheets do the same thing as this work in progress T account. So let's look at the job cost sheet for job number 62. For job 62, you see that the job has a beginning balance on December 1st of $5,000 for material, $3,000 for labor, and $104 for factory overhead. Adding the material, the labor, and the overhead, those total $5,404, and that should be the amount that would appear in the T account for job number 62. Just carrying this on for job 83, you can see that as of the beginning of December, it has not started, so it would contain a zero balance. In short, the material, the labor, and the overhead from the job cost sheet totals $5,404. That's the beginning work in process. All materials are added at the beginning of the process, which would have been November, and so for the month of December, which is this activity for material, labor, and overhead, would be zero. The next thing that we would want to add for job 62 is the direct labor. Information for direct labor comes from the individual time tickets, and then we would want to multiply by the direct labor rate. And for this particular exercise, it's saying that the direct labor rate is $20 an hour. So, using the information from the time tickets, as you see here, we want to isolate the amounts for job 62 from each of the three employees: Susan Blake, who is a knitter, Josh Porter, who is a knitter, and Mary Jones, who is a knitter. So we want to take the information from job number 62. For job 62, Susan Blake worked 65 hours, and I apologize, her rate is $15 an hour. These exercises are what are called algorithmic, so each time they are printed, they create new values. So it's important to be able to read these every time that you do them. So 65 hours for Susan Blake, 75 hours for job 62 for Josh Porter, and 60 hours for Mary Jones. If you would add all the labor together and multiply by the rate per hour, you would be able to calculate the direct labor for job number 62. That amount for job number 62 would be added to the direct labor box in your Cengage answer sheet. The third step that you would have is to determine the factory overhead. So let's just take a minute to examine factory overhead. Factory overhead is based on an estimate. Here's the story. Direct material and direct labor are easy to trace or associate directly with each of the jobs because you have material requisition paperwork that documents how much material is used, and you have time tickets to document the number of hours the employees work on particular jobs. Factory overhead is a different type of concept because factory overhead consists of many things: heat, light, power, depreciation, and taxes, and so forth. The company doesn't know until the end of the year how much factory overhead in total will be incurred. So the company must do some estimating. It does this estimating by calculating this predetermined rate, the PDR, at the beginning of the period by estimating the factory overhead cost that it thinks it will incur as of the beginning of the period. They do this during their budgeting process. And then they estimate the number of units in the cost driver. So the estimate of the cost divided by the estimate of the cost driver will produce this predetermined rate, the PDR. To allocate or estimate how much factory overhead goes to specific jobs, you would take the cost driver, which in this problem is the direct labor hours, times the PDR that would be calculated at the beginning of the period to get the factory overhead that would be allocated. Okay, now let's see where this factory overhead is handled. factory overhead will have its own general ledger or T account. And here's how this game works. As costs are incurred during the year, this is the current year, so as costs are incurred for supervisory salaries, depreciation, insurance, taxes, utilities, and all the other costs that comprise factory overhead, they are used to increase or decrease the factory overhead account. As jobs are completed, a certain portion of that cost that's incurred is allocated to the various jobs using this PDR that we just calculated. Now remember, this PDR is an estimate, and any estimate may be right, it may be wrong, it may be over, it may be under, so there is a built-in error to this system. So here's how it works. During the year, as jobs are completed, the factory overhead account is reduced and the work in process account is increased for the estimated amount of factory overhead charged to each of the jobs. So that at the end of the year, the actual amounts of factory overhead will appear on the debit side of this account. The estimated amounts that are applied to jobs are shown on the credit balance. Rarely do these two numbers equal. Sometimes there will be more left-hand debit charges than there would be right-hand credit amounts applied to work in process. In the case where there are more debit entries in factory overhead than credit entries in factory overhead, the factory overhead is said to be under-applied to jobs. Too little has been transferred from the factory overhead account to the individual jobs. To correct that at the end of the year, cost of goods sold will be increased. In other words, there will be a credit made to factory overhead to make it zero, and the offsetting debit would go to cost of goods sold to increase that amount, cost of goods sold. On the other hand, if the PDR is overestimated at the beginning of the year, meaning that actual overhead costs incurred were less than what was budgeted at the beginning of the year, too much overhead would be charged to specific jobs. So in that case, where there is too much applied to jobs, overhead is said to be over-applied, which means that cost of goods sold has absorbed too much overhead and needs to be reduced to show the overestimate in the PDR. So in the second case, where there is over-applied overhead, factory overhead would be debited to decrease it, and cost of goods sold would be credited to decrease cost of goods sold. At the end of every year, though, or of any period, the factory overhead account should show a zero balance. Now, what about the various costs that are going into factory overhead? So let's just go after this predetermined rate. For the predetermined rate, the information that we are given indicates that the company, because of the labor-intensive nature of knitting, is more labor-directed than it is based on the machine hours that are used. And as a matter of fact, it says in this exercise that the machine hours that are worked would only be about 2/3 of the direct labor that is worked. And so management judgment says that, okay, this company would be more appropriate to use direct labor hours as the cost driver rather than machine hours. Okay, so direct labor hours will be the cost driver that the company would use as the denominator for the PDR. So for this company, we would show direct labor hours in this case as the cost driver. Other examples that we would have in this chapter could use machine hours, but that would depend on the nature of the company. The next step that we would need to do is to determine which of these costs would be overhead and which would not be overhead. Depreciation is always overhead. We have a special case with the office manager and the supervisor that's held with one person, and so the number of hours that the individual works as a knitting supervisor, which is part of manufacturing, would be considered factory overhead. The time that this manager spends on office work, which is not a manufacturing operation, would be part of an administrative costs and would be excluded from factory overhead. I'll let it up to you to determine how many hours the office manager spends on each duty depending on the write-up of your particular problem. Estimated utilities for the office would be excluded from factory overhead because an office is for administrative work and not for the knitting operation. Estimated factory utilities would be included in the factory overhead, and factory rent would be included. So of these costs that you see, you need to determine which would be factory overhead and which would be administrative costs. Only those costs labeled as overhead would be used as the numerator for the PDR rate to apply work in process to, apply factory overhead to work in process. Also, they are telling you that direct labor hours would be the cost driver for this exercise instead of machine hours. One other item that I will point out to you, and that is the trial balance. You'll notice that the trial balance shows a work in process inventory of $5,404. It is not by coincidence that that $5,404 exactly equals what the job cost sheet shows as the beginning balance for job number 62, the only incomplete job as of the beginning of December, and the amount that would appear in the general ledger account for work in process for job 62. Your job for this particular problem is to determine what amounts would be placed in materials, labor, and overhead for job 62, and the amounts for materials, labor, and overhead that would be allocated to job number 83, and then to make the appropriate journal entries for each of those items. That's a long-winded explanation of what this problem is to do. Give it a shot and see how it goes. If you have questions, please do not hesitate to contact me.